Hi, everybody. Thank you so much for joining Kaiko Research's September Analyst Call. We are here with the Kaiko Research team. My name is Clara. I am the Director of Research, and we are joined by Riyadh and Desi. And today we're going to be talking about the latest crypto market trends. We have, of course, the theme of the Bitcoin ETF. It was a pretty big deal, and essentially every price catalyst was triggered by some news about a potential Bitcoin ETF over the summer. So we will walk you through what happened and what is to come, looking at the impact on liquidity and volatility. But we also have a few more special analyses that we are going to present. Riyadh's going to talk about stablecoin stability, and I'll talk about liquidity concentration. So we have a bunch of charts and a lot of data to share with you guys today, and we're excited to be back after the summer. So without further ado, I will continue and we'll start the September analyst call. As a reminder, you can already register for our next call in October. So first, a bit about Kaiko, in case you are new here. Kaiko is a crypto data provider. Today, we offer 4 data services. The first is our market data. We today collect tick level and aggregated data from more than 100, both centralized and decentralized exchanges. We also offer BMR compliant rates and indices. This is EU regulated BMR compliance, and you can use these rates and indices for any investable product. The third business is our quantitative analytics. This includes tools like our value at risk estimator and our implied volatility. And then fourth, this is research. And this is essentially what you'll be hearing from today. All Kaiko research is powered by our data products. So in case you haven't seen yet, we have the new home of Kaiko Research, research.kaiko.com. You'll find here a database of all of our insights, our reports, and our previous analyst calls. And I sent the link in the chat. In case you are new, again, we offer 5 research products. We have our 2 newsletters sent on Monday, the data debrief, and on Thursday, the deep dive. We have our quarterly report, which will be coming out in a couple of weeks. We have a weekly chart book, which is just refreshed charts every Monday. And then finally, we have the current. This is the analyst call that you are here today for. And last but not least, we have research powered by Kaiko Data, just a bit about all of the different data types that we offer. Today, we collect from more than 100 centralized and decentralized protocols. And this includes everything from highly granular order book data to tick level trades to liquidity pool data and lending and borrowing rates. You can learn more about our data products at kaiko.com, and we're happy to provide any more information to you after this call. And in case you are interested, some latest Kaiko updates, we have recently launched 2 products. This is our Asset Liquidity Metrics. It's essentially a tool for researchers to understand the liquidity of a crypto asset. And then our new product, Robust Pair Prices. This is an outlier-resistant pricing tool. We will also be in Singapore for Token 2049 this week in case we have any APAC attendees. And then finally, we have a new data guide for sell-side actors. This is the sell-side handbook for digital assets data. I've just sent the link for that in case you are interested. So now I'm going to leave the floor to Desi. Desi will talk about the impact of ETFs, looking specifically at volatility and liquidity. And we are going to change seats because we only have one Ethernet cable.
So, hello everyone. I will start with a short recap of the main ETF-related dates. So essentially, the SEC has up to 240 days to review ETF filing after it is added to the Federal Register. This process can be divided into 4 periods. One initial period of up to 45 days, second period of 45 days again, then 90 days is 60 days. And so this infographic essentially shows the main deadlines. Each number corresponds to a period. The blue dots refer to ARK in 21 shares, and then the orange dots refer to BlackRock and 7 other asset managers, which essentially filed for an ETF at the same time around mid-June, and then the filing was added to the Federal Register in July. So there are 2 key things to see. One is that 21 shares and ARCs have a bit of a first mover advantage, which we know is kind of important in this space. We saw this with B2, the first future Bitcoin ETF. They filed in April, and then their filing was added to the Federal Register in mid-May. So this is when their 240-day period started. So Bloomberg expects that a decision should be made around January 10th for ARC. Next, BlackRock and 7 other asset managers applied in June, and then their period started in July. Now the SEC has delayed all these spot Bitcoin ETFs at the end of August, and the next important deadline we have is mid-October for BlackRock and the 7 others, and around November for 21 shares. This is kind of important because it coincides with the possible listing of several Ethereum future ETFs, and also because seasonality starts to have a bit of a positive impact on risk assets mid-October. So it would be interesting to see what happens there. And then, as I mentioned, the deadline for ARC is January. So these are the main ETF dates. What happened with volatility? This is the next chart. This is Bitcoin historical volatility, the 20-day volatility and the 180-day volatility. It's historical, so backward looking. What we essentially see is that the 20-day has increased in August. It spiked to its highest level since June. And this was mainly due to the huge sell-off we had mid-August, which was driven by macro factors, mainly some data, negative data out of China, some repricing in rate cuts expectations for next year. But overall, the 180-day volatility has been low. It's around 43%, which is half what we had last year. So we are still in a low volatility regime. Next, let's look at trade volumes. So these are the ranked daily volumes since 2021 for Bitcoin. So the data used for this chart, it's our asset metrics, which essentially cover all Bitcoin trading pairs with Bitcoin as a base or a quote asset, or no exchanges in our coverage. And I have highlighted some of the market events I just mentioned. So we have Grayscale, we have the delays of Bitcoin spot ETFs, the BlackRock ETF failing. Grayscale has been by far the most relevant and the most significant market events for Bitcoin in terms of trade volumes. But overall, trade volumes have been pretty lackluster this summer, didn't increase a lot relative to previous years. And looking more closely at Grayscale and what happened there, the next chart shows the cumulative volume data, which is essentially the difference between buy and sell volumes right before the Grayscale market event. Positive indicates net buying, and then negative indicates net selling. This covers the main Bitcoin trading pairs on the main exchanges, and we essentially see that we did have a spike in buying on Binance, but it was pretty short-lived, right? It turned into net selling right after. On Coinbase, it was a bit more sustained, but again, it turned into net selling in the beginning of September. So essentially, we didn't have any sustainable increase in demand, and this is pretty obvious when we look at derivative markets as well, which is the next chart. It shows the Bitcoin funding rates since the start of Q3. Funding rates have been pretty neutral to slightly negative since mid-August, which essentially means that the market lacks direction and narrative. And the interesting thing here is that even after the ETF Grayscale developments, we didn't see a pronounced increase in funding rates. So overall, this low volatility, low volume environment have been impacting liquidity. And this is our next chart, which shows overall crypto liquidity for Bitcoin, Ethereum, and the 30 largest altcoins by market cap. Liquidity has been pretty flat throughout the course of this year. It has remained below its levels from before FTX, pretty significantly below, almost half. And this is because market makers are not incentivized to provide liquidity when volumes are low. So Clara will talk a bit more about liquidity, and now I'm going to leave the floor to Riyad, who's going to talk about stablecoin stability.
Yeah, thank you, Desi. Yeah, so we'll shift gears a little bit and talk about stable coins in what has been a tough couple of years for stable coins. But the deep dive that we wrote a couple weeks ago was really intended to address an issue that I've seen, which is that we have no sort of unified definition of what a depeg actually is. If you say that it's when a stablecoin trades a couple hundredths of a cent off of the dollar, it sort of loses its meaning because stablecoins under that definition are constantly depegging. So with that in mind, let's move to the first slide and just sort of show the result of this metric that we got. Of course, it shows huge depegs for USDC and DAI in March, but then it also shows a pretty significant TUSD depeg in June. But sort of most interestingly, it shows Tether depegging pretty severely in August, followed by some minor depegs throughout the month. So I'll just quickly go through the methodology. I'll drop the link to the deep dive that has a bit more explanation if you're curious. But yeah, let's move along here. So I think probably the most important thing here is that depegs the threshold should depend on how much volume a stablecoin has. USDT has hundreds of times more volume than DAI. So that means if it were to trade at 99 cents, much more volume is lost much more value is lost than if DAI were to trade at 99 cents, for example. And to address this, we created this sort of simple depeg threshold that scales and shrinks as monthly volume increases. And the most obvious sign here is you can see TUSD in gray. It's had very low volumes in February. Then Binance started promoting it. Its volume increased, and it quickly became one of the smallest thresholds to depeg. And you can see, DAI, for example, now has the largest thresholds. Again, just doesn't have that much volume relative to Tether or TUSD. So then the next component of this, if we move to the next slide, is sort of to take into account the different volume profiles of each stablecoin. The most obvious examples here is like BUSD. That huge orange circle is BUSD Tether on Binance. That accounts for nearly all of its stablecoin to stablecoin volume. If you look at like USDC or USDT, you can see that they're much more distributed. They have volume on a lot of different pairs. In USDC's case, you can see that some of the largest pairs are Uniswap V3 and Curve. So more sort of DEX skewed. So we signed just a simple point system to that, to each pair. And on the next slide, we can see why that's so important. Okay, great. So you can see that USDC actually depegged most frequently on Uniswap V2. And Binance US, there were obviously liquidity issues on that exchange that we've covered. But those depegs are not weighted very heavily under this system because there's just not that much volume going through the pairs on those exchanges. You can see that Uniswap V3, Curve, Binance, Bitfinex, Kraken, they all have a lot of volume. So even though Binance hardly ever showed a USDC depeg, it's weighted pretty heavily because of how much volume comes through that pair. And then sort of tying it all together on the next slide, we can see which exchanges contributed the most to each stablecoin's DPEG, USDC and DAI, of course, depegged on every exchange in March. But sort of the more interesting stuff comes after the really obvious depegs. You can see that TUSD depeg in June, again, heavily Binance weighted because almost all of its volume comes on that TUSD Tether pair on Binance. But there's sort of some interesting stuff too with Tether. In June, you can see that it had a pretty, across the board depeg in June. And then in August, it's pretty concerning to see it depegged on Binance, Uniswap, Kraken, and it didn't really get talked about too much because in price terms it wasn't that large, but given Tether's volume, I think it's fair that it should be held to a bit higher of a standard relative to other stable coins. And then on the next slide, we just have a slightly different way of, oh, never mind. But yeah, so I think Tether's issues sort of stem from its 0.1% redemption fee, which makes its supply, more inelastic than you want for a stablecoin. You really want to have supply that scales up and down, exactly with demand, because right now it's rational for some people. If you don't want to pay the fee, you sell it on the open market. And as liquidity has been, depressed for a long time, there's just not enough liquidity to absorb that selling. So, the big Tether depegs in August came after we saw some massive selling on like Huobi and Binance. So, it's something to keep an eye on. I think that, if Tether doesn't change this redemption fee, that these kind of like, price terms, minor depegs will become very common. And you can see that when they last a long time, that it does add up, and it is sort of cause for concern, and people will be a little bit more wary to hold the stable coin. And
Great, thanks. So just a reminder, if you have any questions, you can actually ask them, and we have time for Q&A at the end of the call. Right now, I'm going to talk a bit about the state of altcoins, just a quick section, because I know a lot has happened over the summer that we don't want to miss out with our analysis. So I think most important, though, is what happened with Ripple and XRP. Essentially, a judge ruled in partial favor of Ripple about whether it had actually created an unlicensed security in the XRP cryptocurrency. And so this was a big win for Ripple overall. While it still remains to be seen if there's going to be an appeal by the SEC, XRP rallied immensely, although it has since crashed. So I think that's a key thing to note, that most XRP gains are gone. Yet we did see a big surge in volume. So here we wanted to look at the top 10 average daily volume in August for the top 10 altcoins. And we can see here that XRP is a league above the next largest altcoin, which in this case is Solana when it comes to volume. And so this just shows that XRP, there have been many investors waiting on the sidelines to trade XRP. Right after the judge ruled in partial favor of Ripple, many exchanges in the United States relisted XRP, one of them being Coinbase. And so we saw a big uptick in trade volume for this crypto asset. It remains to be seen if this will persist into the fall. But overall, it shows that there still is some interest into altcoins beyond just the usual bunch. So overall, though, we want to now contextualize trade volume. We have a similar chart as what we showed for Bitcoin. Here we show the ranked daily volume since 2021. This time it's just altcoins. It takes the top 30 altcoins by market cap. with some key events that happened over the summer. So you have the Ripple SEC ruling, which actually caused a big rally for many altcoins beyond just XRP, and it ranks about average in terms of daily volume. But you'll notice towards the end of the summer, when we had all of the ETF rulings, the Grayscale ruling, the BlackRock ETF filing, and then you had the SEC delays in the spot ETFs, these volume days were not that high. And this just goes to show that even though all of the ETF stuff was considered a very big catalyst for crypto market activity, in the grand scheme of trade volume over the past 3 years, it has been relatively minor, which shows that investors, no matter how good or bad the news, are still sort of waiting on the sidelines for something a bit bigger. So it wasn't all just the top 10 altcoins that saw activity. Meme tokens also saw a lot of trade volume this summer. In fact, a lot more than your average cryptocurrency. So the persistence of meme token activity is something that we've covered quite a bit in our research. But again, it's always a bit mysterious to understand why some meme coins tick up and trade more than others. And in fact, we had a new entrance. This was Pepe, a meme token that initially saw huge volume back in April, but continued to see relative significant volumes for a meme coin over the summer. And so if all other crypto markets are down, at least we have meme coins. And then finally, the last altcoin chart I'm going to show is specifically looking at market depth on US available cryptocurrency exchanges. The previous 6 months have been really tough for United States exchanges. There were multiple SEC lawsuits targeting exchanges, essentially alleging that they are offering unlicensed securities. They listed dozens of altcoins in these lawsuits. So it's been very tough for specifically altcoin trading on US exchanges. So the question we wanted to ask is, how has this impacted market depth? Market depth takes the quantity of bids and asks on order books, and it sort of gives a general gauge of how market makers are reacting to market trends. And so we can see here a pretty interesting trend in that on US exchanges, altcoin market depth is heavily concentrated on just really 2 platforms. This is Coinbase and Kraken. You have Bitstamp in third, but overall Coinbase and Kraken are really neck and neck when it comes to liquidity, whereas every other US available exchange has relatively thin altcoin order books. So this essentially tells you, if I want to buy and sell a lot of altcoins, I'm probably going to use one of these top 3 exchanges. So the final section we have today is on crypto liquidity concentration. This is a deep dive that me and Desi wrote last Thursday, and it's essentially a new type of liquidity analysis. We've done quite a few different liquidity reports over the years, but this one aims to answer the question, how concentrated is liquidity in cryptocurrency markets? We define liquidity as trade volume or market depth. So we look at these 2 measures, and here is sort of the final analysis. This is the ultimate chart, and it shows the concentration of liquidity, both market depth and trade volume in 2023 on all of the top exchanges. So it actually this includes data from more than 50 exchanges. So an example of how I can read this chart is the top exchange for market depth accounts for 30.7% of global market depth, which encompasses like dozens of exchanges, whereas the top 8 largest exchanges for market depth accounts for 91.7% of total market depth. Same with trade volume. We can see here that the top exchange accounts for 64.3% of global trade volume, whereas the 8 largest exchanges account for 89.5% of global trade volume. So the main conclusions we can draw from this data is, 1, crypto markets are really concentrated on just 8 platforms. And 2, the top exchange has an inordinate impact on global liquidity. There's no surprise really what the top exchange is. It is Binance. Yet we can see that Binance accounts for a lot more trade volume than it does for market depth. This is almost solely due to its 0-fee trading promotions, which essentially caused a big surge in trade volume over the past year. So the next question we have is, has crypto markets become more concentrated over time? So here we're looking now specifically at trade volume comparing 2021 to 2023? And the quick answer is yes, cryptocurrency markets have become more concentrated over time. In 2021, the top exchange, in this case, it was still Binance, accounted for just 38.3% of global trade volume, whereas in 2023, 64% of volume for the top exchange. And we've seen a slight increase for the top 8 exchanges as well. So this shows, yes, trade volume has become more concentrated on just a handful of platforms. The same goes no, it's actually a little bit better for market depth. In 2021, the top exchange accounted for 42% of market depth, whereas in 2023, it accounts for just 30% of market depth. And we've seen a slight decrease for the 8 largest exchanges as well. But overall, it's clear that still the top 8 exchanges account for more than 90% of global market depth. So who are these liquid exchanges? Who are these big top 8? No surprise here, Binance takes the top spot for both market depth and spot volume in both 2021 and 2023. For market depth, Coinbase also comes second, and for spot volume, OKEx comes second in both year. We've seen a slight shift though. Most notable is that Huobi used to rank third for both depth and volume, but has since fallen quite a bit. And we've also seen an increase in liquidity on Kraken. So Kraken has actually performed pretty well throughout the last year's bear market. And some other notables is Binance US. Binance US now is very lowly ranked and doesn't really appear on any spot volume rankings anymore. So I think that is about it for our liquidity concentration. We can now move on to Q&A, and you can already register for the next October analyst call here. I'm sending the link right now. And without further ado, feel free to type some questions and we can respond to them. So I see one Q&A from Leo Martinez. He asked, how much trading volume do perpetuals get relative to spot markets in US and offshore? That's actually a good question. We recently looked at that, but maybe Desi, if you remember better the exact data.
I can write it down.
Yeah, I believe that overall derivatives still get higher volume than spot.
6 times higher.
Yes, they get about 6 times higher derivatives volume than spot. Second question from Tony Majorca, are any of these dashboards available with live data for public use? So we will actually be launching a data visualization platform in about 4 to 6 weeks. So look out for that. If you're registered to our emails, you'll be on the list, and this will include some of our famous liquidity data that will be publicly available for browsing. Other than that, Kaiko is an enterprise data provider, so you can always contact us about enterprise data sales. How can we interpret the differences between market depth and volume? So I think the core difference we saw here had to do with trade volume, and specifically Binance trade volume. So over the past year, Binance has had several zero-fee trading promotions for their Bitcoin trading pairs. This caused trade volumes to absolutely soar on the exchange. And it essentially skewed a lot of the data we get. Binance market share increased by about like 20% from the time before they did zero-fee trading to after. And so it seems that they did these zero-fee trading promotions, but they did not actually see an increase in market depth. Rather, it was only on the price taker side, which looks at trade volume. So second question is, do you also take in consideration for the volume the on-chain data from DEXs? So in this analysis, I believe we do not, but Kaiko does have DEX trade data, and we frequently do analysis of DEX trades. Okay, any more questions? I see we have some active typers in the chat, but okay, so next one from Tom. Do you try to isolate institutional versus retail activity? So we get this question a lot. It's very hard because all trading data is anonymous. We collect this data directly from exchanges, which essentially means that we're just getting anonymous IDs. So it's very hard to know what is institutional versus retail. The cool thing is that there is one public cryptocurrency exchange. This is Coinbase, and Coinbase has a regulatory obligation to report this data. So for the first time, we actually know what the breakdown in institutional versus retail trading activity is on Coinbase, which can be used as a pretty useful gauge for other cryptocurrency exchanges. I don't remember the exact numbers now. Maybe Desi, you know better.
I think institutional are dominant in volumes.
Yes, institutions essentially are dominant in volumes,
Yes.
but the exact data is available on the regulatory filing that they do every quarter. Okay, any last questions? We are happy to send any of the PDF of these slides after the call. Simply email us at research@kaiko.com, and we're happy to answer any additional questions. Thank you all for joining today, and we will see you in October 10th.
Thanks, everybody.